Hello, class. I hope you are well. This afternoon, we are going to cover Chapter 4. Chapter 4 deals with corporate governance around the world. This is the chapter outline. We'll talk about all these topics here, ranging from the corporate governance on the public corporation to the Dodd-Frank Act, which is a very important piece of legislation which was passed by the United States Congress. So let's get started. First, we note in passing that corporations are jointly owned by a multitude of shareholders that are protected by limited liability. Corporations constitute a major organizational innovation of vast economic consequences. Corporations foster an efficient risk-sharing mechanism that allows them to raise large amounts of capital at relatively low cost. Corporations have played a pivotal role in spreading economic growth and capitalism worldwide over the last few centuries. A key weakness of a corporation, though, is the conflict of interest between managers and shareholders, because those that manage the firm are not necessarily those that own it. In principle, the shareholders elect the board of directors, which in turn hire managers to run the company. In reality, management-friendly insiders often dominate the board of directors, with relatively few outsider directors that can independently monitor the management. In the case of Enron and other dysfunctional corporations, such as Health South, the boards of directors grossly fail to safeguard the shareholder interest. Furthermore, with diffuse ownership, few shareholders have strong enough incentive to incur the cost of monitoring management themselves when the benefits from such monitoring accrue to all shareholders alike, and this creates the free rider problem. Shareholders allocate decision-making authority to the managers. Residual control rights refer to the right to make discretionary decisions under those contingencies that are not specifically covered by a contract. Managers can exercise substantial discretion over the disposition and allocation of investors' capital. In this case, investors are no longer assured of receiving fair returns on their funds or investments. With the control rights, managers may allow themselves to consume exorbitant perks. For example, private jets worth tens of millions of dollars. They can go out and spend tens of millions of dollars on the purchase of private jets for their personal use. This certainly is not in the shareholders' best interest. Managers may also steal funds, right, through transfer pricing. Self-interested managers may also waste funds by undertaking unprofitable projects that benefit themselves but not the investors. Managers may also adopt anti-takeover measures to ensure personal job security. Now, there are several remedies that can be used to alleviate the agency problem, and those range from putting in place independent boards of directors, right, to having your stock listed overseas. So these are all important remedies that can be used to ensure that managers act in a way that is not against the interests of the shareholders of the firm. So let's begin with the board of directors. Again, this is a mechanism that can be used to align the interests of the managers with those of the owners of the firm. In the United States, for example, shareholders have the right to elect a board of directors, which is legally charged with representing the interests of the shareholders. What about Germany? Well, corporate boards are not legally charged with representing the interests of the shareholders. Rather, corporate boards are charged with looking after the interests of all stakeholders. Okay? And here we're thinking of workers, creditors, and so on in general. In Japan, most corporate boards are insider dominated. Incentive contracts. This is another tool that can be used to align the interests of managers with those of the shareholders of the firm. Though managers have great discretion over how to run the company, they own relatively little of the equity in the company they manage. To the extent managers do not own equity shares, they do not have cash flow rights. Incentive contracts, such as stocks and stock options, exist to better align the interests of managers with those of the investors. Senior executives may abuse incentive contracts by artificially manipulating accounting numbers or by altering investment policies so they can reap enormous personal benefits. This has been shown to exist or to have existed in the United States. Concentrated ownership is another tool that can be used to monitor management. An effective way to alleviate the agency problem is concentrated ownership. If one or a few large investors own significant portions of the company, they will have a strong incentive to monitor management. Concentrated ownership of a public company is rare in the United States and the UK, but normal elsewhere in the world. Research suggests that large shareholders play a significant governance role. Accounting transparency is another tool that can be very helpful. Strengthening accounting standards can be an effective way to alleviate the agency problem. Managers may be less tempted to cook the books if companies are required to release more accurate accounting information in a timely fashion. To achieve a greater transparency, however, the following steps are very important. Countries should reform the accounting rules. Companies should have an active and qualified audit committee. Debt is another tool. If managers fail to pay interest and principal to the creditors, the company can be forced into bankruptcy and its managers may lose their jobs. Debt can serve as a substitute for dividends by forcing managers to disgorge free cash flow to outside investors rather than wasting it. Excessive debt, however, creates its own problems. Excessive debt may induce risk-averse managers to forego profitable but risky investment projects, thus causing an underinvestment problem. Shareholder activism is another tool that can be used to monitor managers. Activist investors have started to play an important role in promoting shareholders' interests. Maybe individual investors, pension funds, or mutual funds. So these activist investors come in different forms. Again, they may be individual investors, they may be pension funds or mutual funds. They pursue social and political agenda by promoting changes in companies' environmental, social, and governance practices. The focus on corporate social responsibilities and an increasing in gender ethnic diversity on boards of directors. Overseas stock listing is another mechanism that can be used to monitor managers. Companies domiciled in countries with weak investor protection can bond themselves credibly to better investor protection by listing their stocks in countries with strong investor protection. That is known as cross listing when you have your stock listed on multiple exchanges. The studies have confirmed the effects of cross-border listings. Specifically, foreign firms listed in the US are valued more than those from the same countries that are not listed in the US. Market for corporate control. The market for corporate control can have a disciplinary effect on managers and enhance company efficiency. If a company continually performs poorly and its internal governance mechanisms fail to correct the problem, an outsider may be prompted to mount a takeover bid. In a hostile takeover attempt, the bidder typically makes a tender offer to the target shareholders at a price substantially exceeding the prevailing share price. Now let's examine the interplay of law and corporate governance. Commercial legal systems, for example, company, security, bankruptcy, and contract laws of most countries derive relatively few legal origins, derive from relatively few legal origins. Okay, they derive from the English common law, the French civil law, the German civil law, or the Scandinavian civil law. The two most influential legal systems are the English common law and the French civil law, with the English system offering more protection to investors than the French system. The United Kingdom and its former colonies, including the US, Canada, Australia, India, etc., have the English common law system. France and the parts of Europe conquered by Napoleon, for example, Belgium and Italy, Spain, etc., as well as former overseas colonies of France, the Netherlands, Portugal, and Spain, have the French civil law tradition. Law or laws do have consequences. The protection of investors' rights has interesting legal origins, but also major economic consequences to the following: the pattern of corporate ownership and valuation, the development of capital markets, and economic growth. The protection of investors can have significant economic consequences. For example, Italy and the UK. Let's look at this table here. The question here is, does law matter? And so this is a comparison of Italy and the UK. If you look at the legal origin, now Italy, as we mentioned earlier, is under the French civil law, while the UK is obviously under the English common law. Now, in terms of shareholder rights, going from 1 to 5, where 5 is the highest and 1 being the lowest, you can see that shareholder rights has the lowest priority in Italy and the highest in the UK. In terms of the ownership by the 3 largest shareholders, look at Italy, highly concentrated, 58% versus only 19% in the UK. Look at the stock market capitalization as a percentage of GDP, 38% in Italy and a whopping 208% in the UK. Shareholder rights again refer to the anti-director rights index as reported by Laporte, Lopez, Solanes, Schleifer, and Vishny in their 1998 study. Ownership and control pattern. Companies domiciled in countries with weak investor protection may need to have concentrated ownership as a substitute for legal protection. Dominant investors may acquire control through various schemes, such as shares with a superior voting rights, pyramidal ownership structure, inter-firm cross-holdings. Large shareholders, who are often founders and their families, can use a pyramidal ownership structure in which they control a holding company that owns a controlling block of another company, which in turn owns controlling interest in yet another company, and so on. Equity cross-holdings among a group of companies, such as the Keiretsu in Japan and cabals, can be used to concentrate on leverage voting rights to acquire control. What are the private benefits of control? Once large shareholders acquire control rights exceeding cash flow rights, they may extract private benefits of control that are not shared by other shareholders on a pro rata basis. Studies clearly demonstrate large shareholders tend to extract significant private benefits of control in those countries where the rights of minority shareholders are not well protected. Capital markets and valuation. Investor protection promotes the development of external capital markets. When investors are assured of receiving fair returns on their funds, they will be willing to pay more for securities. Thus, strong investor protection will be conducive to large capital markets. Weak investor protection can be a factor in the sharp market declines during a financial crisis. The existence of well-developed financial markets promoted by strong investor protection may stimulate economic growth by making funds readily available for investment at a relatively low cost. A study by Beck and others in 2000, as per this study, financial development can contribute to economic growth in three significant ways. It may enhance savings, it may channel savings through real investments in productive capacities, thereby fostering a capital accumulation. It may enhance efficiency, or it may enhance the efficiency of investment allocation through monitoring and signaling functions of capital markets. Corporate governance reform. Scandal-wary investors around the world are demanding corporate governance reform. It is not just these companies' internal governance mechanisms that failed, right? Auditors, regulators, banks, and institutional investors all failed in their roles. In the case of Enron, for example, the auditor was Lehman Brothers. It was documented later on that Lehman Brothers did a very poor job in auditing Enron. Now, the failure to reform corporate governance will damage investor confidence, stunt the development of capital markets, raise the cost of capital, distort the capital allocation, and even shake confidence in capitalism itself. What are the objectives of reforms? There's a growing consensus that corporate governance reform should be a matter of global concern. The key objective should be to strengthen the protection of outside investors from expropriation by managers and controlling insiders. Reform requires the following: strengthening the independence of the board of directors with more outsiders, enhancing the transparency and disclosure standard of financial statements, energizing the regulatory and monitoring functions of the Securities and Exchange Commission in the United States and other exchanges. Political dynamics. Reform is easier said than done. It is not easy to change historical legacies which produce the existing governance systems. Many parties have vested interest in the current system, and they will resist any attempt to change the status quo. Reformers should understand the political dynamics surrounding governance issues and seek help from the media, public opinion, and non-governmental organizations. Now we'll talk about the Sarbanes-Oxley Act. The U.S. Congress passed the Sarbanes-Oxley Act in July 2002 to strengthen corporate governance. The key objective is to protect investors by improving the accuracy and reliability of corporate disclosure, thereby restoring the public's confidence in the integrity of corporate financial reporting. The major components of the Sarbanes-Oxley Act are the following: accounting regulation, the creation of audit committees, okay, internal control assessment, and executive responsibility. Many companies find compliance with Section 404 onerous, costing millions of dollars. Section 404 is the section that requires public companies and their auditors to assess the effectiveness of internal control of financial record keeping and fraud prevention and file reports with the Securities and Exchange Commission. The cost of compliance disproportionately affects smaller companies or firms. Many US listed foreign firms that have different governance structures at home also find it costly to comply with the Sarbanes-Oxley Act. Some firms have chosen to list shares elsewhere to avoid this costly compliance. The Cadbury Code of Best Practice. The British government appointed the Cadbury Committee in 1991 with the broad mandate of addressing corporate governance problems in the United Kingdom. The committee issued its report in December 1992, including the Code of Best Practice. Yeah. That is the Cadbury Code in corporate governance, and they made some specific recommendations. For example, the board of directors of public companies must include at least 3 outsiders, at least 3 outside non-executive directors. The position of the CEO and the COB should be held by 2 different or separate individuals. Okay, chairman of the board and the chief executive officer should be 2 separate individuals. There should be two separate individuals. Here's what the Cadbury Code said explicitly. It said the board should meet regularly, retain full and effective control over the company, and monitor the executive management. There should be a clearly accepted division of responsibilities at the head of the company, which will ensure a balance of power and authority such that no one individual has unfettered power of decisions. Where the chairman is also the chief executive, it is essential that there should be a strong and independent element on the board with a recognized senior member. The board should include non-executive directors of significant caliber and number for their views to carry significant weight in the board's decisions. Yes, this was part of the Cadbury Code enacted in the United Kingdom, or adopted by the United Kingdom. Back to the United States. In the introduction, I mentioned the Dodd-Frank Act. The U.S. Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in July 2010, and key features include the following. The Volcker Rule. What is this? It says deposit-taking banks will be banned from proprietary trading and from owning more than a small fraction of hedge funds and private equity firms. Another feature was the resolution authority, which basically says government can seize and dismantle a large bank in an orderly manner if the bank faces impending failure and poses a systemic risk to the broader financial system. Derivatives securities were also covered by the Dodd-Frank Act. OTC, or over-the-counter derivatives trading, will move to electronic exchanges where contracts are settled through central clearing houses. Systematic risk regulation also came under the Dodd-Frank Act. Okay. Systematically important financial firms will be identified and monitored. The Dodd-Frank Act also ushered in the consumer protection, where a new and independent Consumer Financial Protection Bureau will monitor predatory mortgage loans and other loan products. Finally, in May of 2018, the U.S. Congress passed a new law known as the Economic Growth, Regulatory Relief, and Consumer Protection Act that significantly weakened the Dodd-Frank Act. It raises asset threshold for application of Dodd-Frank's enhanced prudential standards from $50 billion to $250 billion, exempting most small and mid-sized banks and bank holding companies from stress testing and heightened risk management requirements. Banks and bank holding companies with assets of $10 billion or less are exempted from the Volcker Rule. In my personal opinion, this was a bad move, but only history will tell. Okay, friends, dear friends, this is my summary of this chapter. As always, I ask that you take care of yourselves and stay out of harm's way. Take care.